So if we take a step back in terms of what's happened globally in fixed income markets, post the financial crisis, we saw growth actually taper off quite significantly globally. And what we end up finding is that central banks want to try and stimulate growth. There are two main policy elements that they could try and stimulate growth with were policy rates or trying to increase cash in the financial system through buying back assets. And what we found is that the Federal Reserve in the United States and the ECB started doing buyback programs because their policy rates were quite low at that point in time. So through them buying back assets, part of those assets they were buying back were corporate bonds. And what we found is normal supply and demand dynamics is that corporate bonds started to become expensive. So to put it in context, ECB even actually held Steinhoff bonds. So they were forced to buy a lot of bonds which potentially they would not have normally bought. And that overlay resulted in corporate bonds becoming quite expensive, meaning yields started to become a lot lower. And from PSG asset management point of view, we found that corporate bonds are too expensive and not actually compensating investors for the risk associated with them. Where we are currently in the market is that the ECB has actually stopped their asset buying program as of December, and the Federal Reserve has actually decreased their asset buying program. So what we are expecting going forward is that corporate bond yields should automatically start rising, as the demand for corporate bonds should start tapering off from central banks, and the demand for corporate bonds will still increase from other fund managers and pension funds. But we expected that the normal dynamics in terms of proper risk compensation for corporate bonds would actually start to normalize within the market and fairly reflecting the risk associated with those bonds. So from our point of view at this point in time, and what we actually reiterated last year, is that we do think that corporate bonds offshore are quite expensive. The other big trend that we actually are seeing is in China. So China have also tried to stimulate a lot of growth through fueling debt, so issuing further debt to try and fuel stimulus within the economy. They've also reduced the reserve requirements for their banks to try and get their banks to lend more. What we do feel is that this potentially is not sustainable going forward, because what you're doing is you're increasing debt, but you're not structurally increasing GDP on a long-term sustainable basis. So going forward, what do we see the problems being? Growth globally, I think, is a main concern for a lot of counterparties. How do you stimulate growth globally and keep that momentum going? The other big concern that we have seen in the markets is the trade war between China and the United States. So we have seen Apple being impacted by the trade wars as they have to change their suppliers and logistics potentially. And going forward, we expect a lot of larger global companies could be further impacted by the trade wars. So we should see the impact in the next 12 months. At our roadshow towards the end of last year, we spoke around the emerging market crisis and that risk-off sentiment. And what we actually are finding now is with the Federal Reserve becoming a lot more dovish and the ECB tapering back on asset purchases, as we described earlier, that we actually are getting a bit more of a risk-on sentiment, and we are seeing some further investors coming back into the market. That being said, we expect that global growth as well as interest rates should remain lower for longer. On the local markets, we've seen government bonds, the 10-year and 20-year bonds, at similar levels to what we saw at the beginning of December 2018. We've also seen the Rand at very similar levels. On the short end of the curve, being the 5-year point and lower, we've actually seen the rates come slightly in. So in December, it was 8.2%. It's now sitting at around 8%. We're currently seeing a better opportunity shifting that position to 5-year NCDs, bank negotiable certificates of deposits, where you're actually yielding 8.8 to 8.9%. So it's a far better running yield. What we have seen also over the last year is that foreigners have actually decreased their holdings of South African bonds from 43% in March last year to 38% currently. This is actually, we found, is actually quite a good thing. So those that attended our roadshow last year would remember that we actually spoke around the Moody's scorecards, and one of their rating adjustments was to actually downgrade us by 1 notch because we had a high foreign holding. So given their reduced exposure to South African bonds, we actually find that this should offer a potential added buffer to the Moody's downgrade that the market is expecting. On the local front, what we're also finding is that we obviously are out of our technical recession. Growth is still quite low, but inflation is well within the target bands. The latest inflation print is at 4.5% for December. If you look at the last South African Reserve Bank meeting, it was a unanimous decision to keep rates unchanged. So at this point in time, we don't see a significant pressure in terms of an interest rate hiking cycle. And a similar sentiment is actually seen by the market, where we've seen the front end of the curve actually coming in and less interest rate hikes priced by the market. The other big positive in the markets is that we have seen increased governance in terms of SOEs, where we've seen a lot of board members being fired and a lot more investigations ongoing, which is quite positive in terms of the way forward. That being said, we are going into an electioneering year for May, and we also are expecting a bit more noise come to the budget build-up in February. We're currently finding opportunities on the long end of the curve, being the 10, 15 and 20-year sovereign bonds. We're also finding opportunities in long-dated NCDs, where the 5-year NCDs are returning 8.9%. Global markets, we're not actually finding opportunities in sovereign bonds or corporate bonds, as with central banks reducing their asset purchases, we expect those yields to actually start rising.